In this standalone course module, we will focus on the accounting treatment of subsidiary disposals. In other words, what happens from a financial reporting perspective when a parent stops exercising control over the investee. In this module, we will only be examining those situations where the parent disposes of all of the subsidiary's shares, which it previously held, as opposed to situations where control is lost. Nevertheless, some equity involvement is still retained. Let us first focus on the accounting entries that will appear in the individual financial statements of the parent entity. The disposal proceeds will need to be recorded perhaps as a debit to cash, and a corresponding credit will be required to eliminate the carrying amount of the investment in the subsidiary from non-current assets. Any difference between the amounts of the debit and credit entries will be recognized as a gain or loss in the parent's individual profit or loss. From a consolidated perspective, a subsidiary disposal triggers the following two operations: consolidation of the subsidiary's results all the way up to the date of disposal, and subsequent booking of a gain or loss on disposal in the consolidated income statement, and removal of the subsidiary's assets and liabilities from the consolidated statement of financial position, together with any accompanying goodwill and non-controlling interest. It must be stressed that the gain or loss on disposal, which is booked in the consolidated income statement, is computed differently to the analogous gain or loss as recognized in the individual accounts of the parent. The amount of consolidated gain or loss on disposal is calculated as the difference between the sales proceeds received and the carrying amounts of the various items which pertain to the subsidiary and must be removed from the consolidated statement of financial position. These include the goodwill recognized upon acquisition, less any subsequent impairment write-downs, the net assets of the subsidiary, and non-controlling interest, if the subsidiary is less than 100% owned by the parent. The gain or loss on disposal of the subsidiary may thus be mathematically expressed as the sales proceeds less the carrying amount of goodwill at the date of disposal, less the carrying amount of the subsidiary's net assets at the date of disposal, plus the carrying amount of non-controlling interest at the date of disposal. The gain or loss is recognized in the consolidated income statement.